Hi trader, welcome to this video where I'm going to start with the details about the options basics. Okay, there are all kind of traders. I'm going to explain you how I see options and trying to keep things as simple as possible. I've been trading for more than 12 years. Some of you know me since day one and are with me since day one. And I thank you all to being part of the family. And over the years, I've studied a lot. I've read a lot. I've seen a lot. All kinds of traders that like to buy options, traders that like to sell options, traders that like to go with the spreads, traders that like to go with the stock, with only the options, with shorting the stock, with going long the stock, whatever. There are many kinds of traders. Many kind of strategies, especially with options. You have vertical spreads, you have butterfly, you have risk reversals, we have covered calls, we have everything that you want. You have calendar spreads, whatever you want. You can build it yeah, variant condors, whatever. You have lots of strategies with options, okay? But one of the things that I learned over the years, and I try to work that, is to keep things simple. Very, very simple. Just keep it simple. There are lots of informations, lots of tools, lots of strategies, lots of comments, lots of people saying whatever they want and what they are thinking, and we need to start cutting up the noise. Okay, so I'm going to explain you how I trade for more than 12 years, how I trade, how I see the markets, how I see the charts. You have plenty of videos on the charts, how I build my charts, the main strategies that I use. We going live with several examples on live action, the intraday action happening real live, the candles moving real time. So we have plenty of that. We are going also to see, and you are also going to have videos, and you have on this course, you have videos with options activity and trading options activity and watching options activity happening real time. I believe that it's important to have this video on the options basics to keep it as simple as possible, because options are on the financial studies. Okay, if you go to study finance and economics, options are one of the complex tools on the financial markets. Okay, the simple one is stock, but you start having some complex tools to invest, and options are on the complex part, advanced part, because they are hard, okay, hard to understand. So that's why I keep things very, very simple. The first thing I started trading as a trader, not with the options. I start with stocks. I start looking for the stocks and seeing, okay, this thing goes up, I will buy the stock, I will buy the shares, and when starts seeing some possible reversal, I sell the stock, and I go other way around, I short the stock, and I play the ride down, and it was how I started. Okay, I started penny stocks. I traded a lot of things, okay, until I find options, okay. But over more than 2 years, I believe, I developed my technical analysis capabilities, looking for the charts, but when I start and someone told me more than 10 years ago, have you ever tried options? And I said, what is options? Okay, what is? I don't know what is. And I just Google it, and I look for what was an option, and I start looking for two concepts. One, it was call, and the other, it was put. Okay, so what the hell is a call? What the hell is a put? Okay, try to keep things very, very simple. That's what I always try to look. What is a call? What is a put? Okay, we go by the definition. A call gives you the right the right is a contract that gives you one contract, gives you the right to buy 100 shares of the stock at a specific price and with a specific date, okay, expiration date. The contract it will expire, and you lose the right to buy those 100 shares at specific price at specific date. Okay, that's the right of the call. And the put is the other contract, okay, that you if you buy one put contract, it's a contract that gives you the right to sell 100 shares of a stock at a specific price on a specific expiration date. And it does not matter if the stock goes up, goes down, and goes opposite, okay? You have the right to buy, if you have the calls, buy, for example, you have contracts on the calls, you have one contract to buy 100 shares of stock at $40 and the stock goes to $100. You have the right to buy those 100 shares at $40, even if the stock is at $100. Okay, that's what the contract of the call gives. The same thing happens if you buy the contract to sell, one put contract to sell 100 shares of the stock at $40. If the stock goes from $40 to $10, you have the right to sell your shares at $40, even if the stock is at $10. Okay, so that's the basics. And if you, one of the things, everything that I learn mostly by myself. Okay, looking for the charts, I read a lot all by myself, researching, Googling, go to the Google and start looking for what I needed. And once I start with the options, it was exactly the same. I Google it, options, stock options, and start looking for definitions. And you have the definitions. Call is the right contract that gives you the right, one contract gives you the right to buy 100 shares at a specific price, that's the strike, okay, strike price, and at specific expiration date, okay, and after that the contract, it will expire and you will no longer have the right to buy those contracts, those shares at that price. And the put is exactly the same for the selling part. So after that, I start thinking, okay, how can I use this for my own trading? Because when I think that the stock goes up, I buy the shares, and when I think that the stock will reverse, I will sell the shares. Simple. How I will use options. And the way I look is, okay, when the stocks go up, instead of buying shares, I buy calls. Simple. And I make money when the stock goes up, calls go up, so I make money. But the difference is, if the stock moves, for example, $1, okay, and for example on stock, the stock can move 2-3%. On options, I can be making 100 or 200% depending on the price on the contracts. So that's very, very interesting. Okay, same thing with downside. On the past, when I was looking for a possible downside on the stock, I shorted the stock and I ride it when I think it was the bottom, I cover my short and I'm there. And then I start looking, okay, we have the puts. So if I think the stock will go down, I buy the puts and the price will go down. And if the stock goes down, okay, the stock can go down 2%, but with put options, I can be making 50, 100, 200%, 300%, depending on the price of the contract and on the stock. So, okay, so for me it was pretty much simple. Calls, buy calls when the stock goes up, stock goes down, buy puts. For me it was that simple. So I looked into the options chain, and the options chain, it was the place where I could find the different expiration dates and every single contract that I could buy, either for stocks to go up and stocks to go down. So that's exactly what we have here, is a typical option chain. Okay, on the left side you have the calls, on the right side you have the puts. So if you think that the stock will go up, as we are seeing right now, using an example on this specific day on the SPY basically gone up, okay, and gone up for 143%, okay. If you want to play this, you can just buy calls instead of buying the stock, okay, simple. But for example, on the previous day, the stock came down, you could have bought puts and or either short the stock, but this is a very pricey, for more than $400 a share. It's a very pricey one. You could have bought the puts, they are cheaper, and you ride the momentum down with the puts, okay? So that's the simple thing, and you go into the puts on the right side of your options chain. There are several options chains for several expiration dates. So you have in some names, okay, depending on the stocks, you have stocks that have 2 years of expiration dates. So you can buy, for example, today, you can buy on some stocks, you can buy options for next year or 2 years from here. And if you expect that the stock will go in the next couple of years from $20 all the way to $30, you can have, instead of looking for the stock every single day, you can buy the options, for example, and for that period. And you can buy, for example, a vertical call spread, something a bit more complicated, where you reduce the premium, but the premium you paid, and you ride the momentum smoothly, okay? That's a swing long strategy. What I personally use on my trading, as you know, I'm a day trader. We will go to the swing long trading video, okay? So stay tuned for that. I'm mostly a day trader, so I look for the weekly options expiration. But the chains are exactly the same, and that's precisely here that I want to talk with you about the chains. So you have the expiration dates. Some platforms have, as we have here on Think or Swim, have everything grouped as we are seeing here. Some have the options expiration dates, the expiration dates on the top. It does not matter. You will have the expiration dates. You will have the strikes. Okay, the strikes. Those are the price on the contracts. So don't forget the basics on a call. A call gives you the right to buy stock at a specific price, the price of the strike. So for example, if on this day you buy the right when the stock was at $422, and if you bought the right to buy the stock at $422, okay, even after almost $10 move on the stock today, you have the right, unless you sell it, you have the right to buy those 100 shares per contract at $422, even if the stock is $10 up. Okay, so that's the basics on the calls. So what we have here, you have the strike on the middle between the calls and the puts, and you have the price on each contract. So something you can deal with each contract as one stock. Okay, one contract. This contract here, for example, let's pick the 430 strike. 430 strike as a bid, an ask, and a last, and a volume. Okay, that's the basics. You can deal as this contract as a stock, and this also has okay a chart. Okay, and you can go, this is the chart of the price of the option. So basically the option opened at $1.20 and gone all the way, okay, at more than $3. So more than 200% profits on this call. Okay, and the stock, how much moved the stock? Let's go and see the SPY. Okay, the option moved more than 200% and the stock moved 143%. So that's exactly that. When the stocks move 1-2%, you can be making more than 200% on options if you are on the right side. Okay, so you deal with each contract as it was a stock. You have a bid, you have a ask. The bid, the price of buyers, the ask, price of sellers. If you hit the ask, you will immediately buy your contracts and ride the momentum, and you sell it whenever you want. Okay, exactly as a stock. Simple as that. Bid, the ask, the last price, and we have the volume. Okay, and we have that for each contract. Okay. And for each side, for the calls, for the puts, and for expiration date. So lots, and especially I pick the name SPY that has lots of expiration dates, lots of contracts, lots of strikes. So it's very lots of information that you have in front of you. Okay, so that's why when you have lots of information, you need to keep things simple, and that's why I try to keep things simple. So if you search for options, okay, you will see that many traders talk you about the options Greeks. Okay, and the options Greeks is some indicators, okay, on the possible behavior on the options. Okay, you will find traders that talk about delta, gamma, vega, rho, and those are the key Greeks that you will find. You can research. Okay, I've studied it. I know how to calculate those, but for my own trading, I decided that those were not necessarily okay for me, for my own trading. For the traders that deal with the spreads, that deal with other kind of strategies, okay, that can have an impact. Okay, you look for the deltas and look for the gammas and for the vegas, and look for the theta decay and time decay, and look for every single indicator. Okay, for me, once again, I try to keep things very simple, and that's why I look for price. Once again, same thing as the stocks. Okay, if you see, there are many traders that use many advanced indicators, relative strength, MACD, momentum, whatever, okay, overbought, oversold, but all those indicators, all of them come from two things: price and volume. All those indicators, RSI, moving average, MACDs, momentum indicators, whatever, they came all from the close price and volume. The volume and the price are the most important things. So I passed that to the options. The most important things is price and volume. Price goes up with the volume, it's bullish. Price goes down with the volume, it's bearish. Simple as that, okay? So once again, that's my way of trading, and I'm trying to pass that for you. You don't need to be successful in trading. You don't need Greeks. If it helps you, great, keep it. Okay, if you have a defined strategy with Greeks, with advanced tools, keep it. Okay, I'm just letting you know that you don't need that to be successful at trading. Okay, there are other ways, and that's the simple ways that I'm going to try. Trading is hard. Okay, it's very hard. You will miss you, but for that we will have other videos on the risk management and mentality part of trading. Okay, but trading is very complex, very hard to do it over and over, especially for more than 12 years that I've been making. If you keep it the basics, with the basics, and try to simplify things, it will get a little more easier, okay? And you will do it more easily because your brain is trained for that, and you will do it more easily, okay? So back here into the options, once again, left side calls, right side puts. So what I'm looking for price, I'm looking for volume, okay? But on options, we have other and very important indicator, okay? Something that we don't have on stocks, okay? But we have on options. And that, and you're probably thinking already, if you are, if it's not the first time that you hear about options, you know what I'm going to talk about, okay? That's open interest, okay? Open interest. What is open interest? Same thing when I started trading options, okay? And before I start trading options, I had to study it because I didn't have anyone that told me and teach me what were options. I had to look everything by myself. Simple as that. And I Google it. It's simple. So why don't you Google it? Options open interest. And you see the definition. And basically the definition tells you something like that, like this. It's the number of contracts that are open for that specific condition on strike and side, if it's a call, an expiration date. It's the total number of contracts that are still open. At the beginning, that concept for me, it was a little bit weird, okay? Because I didn't understand that. But then I started thinking, okay, if I buy 10 contracts, okay, I will keep it open. So what happens to the open interest? And one of the things that I realized in the first days that I looked into the options chain, it was that volume, it was always changing and always increasing the volume, okay? But the open interest, it was stuck, frozen during the day, did not move. So I start reading a little bit more, and then I found, okay, that open interest only updates overnight. So the updated version of how many contracts are open, it will only come available the following day. So if today we have all this kind of volume that you are seeing here, for example, let's pick this contract here, the 430 strike, you have the volume of 46,825, okay? So we have the volume on the day, volume for call 430, okay? We have 46,825. That's the volume. And the open interest, okay? And the open interest for call 430, it's 25,431, okay? So how do I read this information? So basically at the beginning of the day, you need to see that the volume is at zero, okay? When you start the day, no contract was traded. So the volume was zero at the start of the day, zero. And it gone all the way into 46,000 contracts. But at the beginning of the day, okay, at the start of the day, you had 25,431 contracts already open, okay? That's what open interest means. It means that yesterday, okay, or some days ago or weeks ago, we don't know when, we have buyers that bought those contracts or sold those contracts to open. It does not matter, okay? And we will go over the buy to open and sell to open and buy to close and sell to close and whatever. But those contracts were open. They are still open, okay? They did not close. And I don't care what they are looking for upside, downside. I don't care, okay? They are open. There are traders that bought those contracts and there are traders that shorted those contracts, okay? So for me, I don't know. You will not know what every single trader does in the market, and they can be hedging, okay? They can have the other side, and they can be just hedging their positions, okay? They can be short the SPY and bought the calls just to hedge their short on the SPY, for example, and they are bearish on the market, but they are hedging their portfolio, okay? We can have that. I don't know. You don't know. No one knows. And don't even think that you need to know what the hell they are doing, because that's impossible. That's impossible to know what every single trader is doing when they buy or sell options on the market. So that's information that we have. At the beginning of the day, those contracts on call 430 were at zero and the open interest 25,431. And during the day, this value, the open interest, it will keep stuck, okay? It will keep the same. And it will not change. It will only change next day. But during the day, okay, this value, it will increase. In this case, 46,000 contracts were traded. So what does this mean? Just to show you this. Let's suppose that at 9:30 a.m., the market opens. The volume is at zero. And you decide to buy, okay, you buy 10 contracts at call 430. What happens then? The volume goes from 0 to 10. You bought 10 contracts, okay? And at 9:35, for example, you sell 5 of those 10 contracts. What happens to the volume? And let's suppose this is just for example purpose, okay? Of course you are not alone on this market. But let's suppose that you are alone on this market and you are the only one trading these contracts, okay? What happens to the volume? The volume was at 10, and the volume, you sold those 5 contracts, that volume got into 15. Okay? The volume is always increasing. Either you are buying or selling. Same thing with the stock. When you buy the stock, the volume goes up. When you sell the stock, the volume continues to rise. Okay? But you still have until the end of the, and you decide to hold those contracts. You still hold overnight 5 contracts. You still have 5. Okay? So let's suppose that at the beginning of the day, we have 5, 4, 3, 1 at the open interest. Okay? That's the beginning of the day. So, and you were the only one, once again, this is just as an example, okay? And you were the only one that made trades on that day. Basically, the volume at the end of the day is 15. You buy, the volume was at 0, the open interest was this one. You buy 10, you sell 5, the volume is 15 from your buy and for your sell, and you are holding 5 overnight. You have open 5 contracts and you left still open. What happens on the next day to the open interest? The open interest basically goes up 5. So goes from 5431 to 5436. 5 more contracts. So open interest basically reflects that besides the other traders that have their positions open, those contracts open, they have more 5 contracts, your contracts, that are still open, okay? And we are reflecting on the open interest the number of contracts that are still open, okay? So that's what reflects open interest. So for me, what I want to see on options, and that's why I keep things very, very simple, the simple way as possible. I want to see big open interests on the early morning. Okay, I want to see contracts with big open interest. Because why is that? Because it means that we have still open contracts that sometime needs to close or not. But if the volume starts kicking in on those contracts, we can have big moves one way or the other depending on the stock price, okay? But because in this case you held 5 overnight because you are still bullish, okay? The stock goes up, you are still bullish that next day it can continue, okay? So there are people still bullish on this one, okay? That's why we still have open interest. That's why on the next day I want to see what the hell happened to the open interest. And this tells me that more 5 contracts were open next day. So I only look on options. I only look for volume and open interest. Okay? I look for the price on the stock. I look for volume and open interest. And I look for liquidity once again. I look for contracts that have volume or have open interest. Okay, because if they have open interest and for example if they shorted the contracts and I start buying, okay, and everyone starts buying those contracts, the price will go up and they will need to cover, okay, because they shorted. And that's another concept that I'm going to explain you on what kind of open, okay, you can have on options, okay. You can have buy to open and sell to open, but we are going for that in a couple of minutes. So what I would like to keep you in mind here, trying to keep things very simple, is that looking for the options chain during the day, most of the values that you can find on the options chain are always moving, but the open interest, okay, the open interest only moves on the next day. That reflects the number of traders that still have open contracts, okay? And you cannot anticipate how many contracts from the volume here that you see, and let's get back into our example, okay? let's get back into our example. On the call, let's get back into the call 430, okay? What you have volume on the calls 430, 46,825, and you have volume calls 430, and you have open interest of 25,431, okay? And you don't have any clue, and there is no way you can know how many people open and closed on the same day. So basically, everyone here, if we divide this by 2, everyone can open and close on the same day. You don't know. You don't know. They could have opened at the open and sell it at the close. And what happens next day on the open interest? It is exactly the flat. So because everyone that bought today sold before the market closed, so the change for tomorrow is 0, because everyone bought, everyone sold, and it's 0. You don't know, only tomorrow. So that's why, for example, we are going to see and move for the next day. And let's see what happens on next day. So we are on the next day, and what we see on those contracts, calls 430, what we see on those contracts, we have a new open interest. Next day, open interest is 20,163. So what does this mean? It means that we have lots of traders on here buying or opening contracts and closing at the end of the day. But we also have traders that were holding for longer, and on this move up, they closed more than 5,000 contracts. They close it, okay? And they could have made many things, like profits, or pick those profits and roll to higher strikes. We don't know, okay? We don't know. But that's for other kind of analysis. So first, once again, you need to have well defined what you are seeing on the options chain. We are seeing the bid, the ask, and the last price at those options that were traded, okay, and that are being traded right now, the pricing. You have the volume, that's people that is buying and selling, and you don't have any clue what the hell they are doing. They can be hedging, whatever, okay? And you have the open interest that during the day is stuck, is frozen, does not move. On the next day, it will show you how many contracts are still open. So what does this mean? It means that 5,000 contracts were closed, but we still have 20,000. Okay, so, and it's on the call. So on the next day, they are still a little bit bullish. Okay, they are still a little bit bullish for possible more continuation, because if they decide to close everything, this would close even more. Okay, so this gives you a barometer, and it's something that we need to see. For example, if other contracts, one of the things that I like to do and that I suggest you to do is to see the changes on the open interest. Because, for example, you could have made some conclusion that the 5,000 contracts that closed here moved into the other strikes above, for example, giving some more exposure, 434 or 435, okay? They roll, they closed the in the money calls 430 and move higher into out of the money, giving some possible more upside and rolling over, okay? So that's the principle. Other thing that we have been talking, and I mentioned just some minutes ago, it was the concept of in the money, at the money, and out of the money. Okay, in the money contracts, ITM in the money basically are the contracts. If you look on the call side, okay, and if you look on the put side, you see two areas here that are colored, okay, a little bit different. Those are in the money and those are in the money. The calls in the money, okay, a call in the money is basically a call, a strike price, okay, a strike price that's below the current stock price, okay. So basically the stock is at 431, okay, so stock at 431. Every single strike below 431 strikes at 430, at 429, and so on. Every single one is called in the money, okay? And the contracts that are above the current price are called out of the money, okay? Because they are above the stock price. So stock at 431, the call 432, the call 433, they are always all out of the money, okay? One of the things that you need to be careful is that the out of the money calls, if the price keeps flat, okay, and does not move here, and it keeps stuck until expiration day, until in this case 23 July, okay, they will go, the out of the money calls will go to zero, and right now they are pricing. Why the theoretical value, okay, the fair value here on those calls are basically zero, okay, because why the hell buy the rights of the calls to buy stock at 434 if I can buy the stock at 431, okay? I buy the stock at 431 instead of buying stock out of the money at 434. So why? Because of course there are expectations on the market. There are expectations that the market and the stocks will move one way or the other, up and down. And the options chain reflects the perspective and the anticipation and what the market is expecting that the stock to move, and that's why they are pricing out of the money calls and out of the money puts. And why puts, why sell? Okay, why sell? For example, we have here contracts on the put side at 4 to 5, okay? Why sell and why buy contracts at 4 to 5 if I can sell the stock at 431 right now? It does not make sense. Why? Because puts are very often used as hedges, like an insurance. If the price goes down, I have the insurance, okay? I have the insurance to sell the stock at specific price. And then I don't care if it goes from 3 to 1 all the way into 420. If I buy the right to sell my shares at 4 to 5, I will sell it. Even if the SPY plummet and goes to 420. Okay? So, and you have all those kind of forces on the market. Some are hedging, some are playing for upside, some are protecting for downside, some are betting for the downside. And all those kind of forces, you have it on the market. But once again, try to make and see things very, very simple. Once again, you have the strikes, you have the calls, you have the puts, you have the volume, and you have the open interest, okay? And in the next videos, I will go and we will see examples, okay, and I'll put things all together. Right now, once again, this is not a trading example, is the basics on options, trying to understand the concepts on those options, and we will see live examples in future videos, so stay tuned for that, okay? So more, what you can expect more. So I was telling you that out of the money calls, okay, and that's very important for you to understand. Out of the money calls, everything that is around here, if the stock right now we have 2 days for expiration day, okay, this is we are at 21 of July, and those contracts expired 2 days ago, 23 of July. And all those contracts that are, if the stock stacks here, okay, everything that's out of the money on the calls and also out of the money on the puts will expire worthless because they value zero, okay, they value nothing, okay, because you can buy the stock and not necessarily buy the calls or the puts to hedge your position. You buy and sell at the current price, okay. So that's something you are always fighting as a buyer on contracts, on options. You are always fighting with the out of the money and fighting with the time decay, because every second, if the stock does not move, every second that pass, the value on those options will decrease, both on the calls and on the put side. If the stock is stuck and if nothing happens, okay, the value on those contracts will decrease and you will lose money, either if you have calls or puts, okay, unless there are other things. And there is an important thing that I will not get into detail here, but it's also very important, is the implied volatility, okay. You can Google it, there are lots of information about that. The implied volatility, if implied volatility rise, okay, because price, they keep buying contracts even if the stock is flat. If they keep buying those contracts, the implied volatility will rise. It means that someone is expecting the stock to make a move out of that range, and we will look for directions on that price, okay, on that stock. But that's something that we will leave for future live examples, and we will have a live example of that, okay. Other thing that you need to be aware, okay, another thing that you need to be aware is the difference, okay, the difference between buying out of the money and in the money call. For example, if you are looking for some upside, the out of the money, and we have lots of traders that only buy out of the money, the out of the money are cheaper, okay. And why is that? Because the fair value of those contracts are zero. Because if the stock stays flat here, at the end of the expiration date, they will value zero. So the value of those contracts will be zero. But if the stock rises, those contracts will have a price jump much bigger than the contracts that are in the money, okay. That's something that we will discuss in future videos, how to buy, if we buy in the money, at the money, or out of the money. It depends on the move that you are expecting, okay. But never forget that if you buy more out of the money, the more the risk you will lose, because if the stock does not go to that strike price, and the move can be not enough for you to make the money that you are thinking that you can do, okay. So you need to deal with the size of the move and how far we are from the expiration date, okay. But that's other things. Another thing that I would like to talk with you is the impact on the open interest about what are done with the contracts. So I've told you about two things. There are two things on the options market that impact open interest. Okay, you can buy to open. You can buy to open, and you buy to open calls, for example, because you think that the stock goes up. Okay, and you buy to open you go long basically 10 calls for 130. Okay, and you pay, for example, today calls for 130 at $3. If you go at the ask, you buy at $3.30, and you pay $3.30 plus 100 plus 10. Okay, so you basically spend here you spend here, okay, on buying those contracts, okay, on buy to open. But let's suppose that you think that the stock, it will go down, okay, and it will pull back, and you are seeing right now those contracts for 30 at $3.30, and you think that the stock will go down. But it's just a small pullback, and it will go below, okay, it will go below 430. And we are going to the expiration date, okay, and they will go below 430. I don't know if they go or not. This is just for informational and educational purpose only, okay? But if the stock goes from 431 that we closed, and if it goes below 430, and on this day, 2 weeks ago, two days from here, okay, if they, at the expiration date, the price is below 430, below your strike price, okay, those contracts will go to $0. Okay, so basically you lost $3,300. But that's why we have other kinds of traders that are looking for the other side of the trade, and they sell to open. So basically what they are doing, they are shorting the stock, the contracts, okay? They are shorting. Why? Because they have the same expectation that the price will go down, okay? So they will take the opposite trade. They will short calls for 130, okay? And they will get credit, okay, on their account on the same value that you spent, okay? And they will short at $3.30 per contract. Okay? So they credit $3,300 on their account. But when you short something, you will need to cover it. And this is on the case that the stock goes down. But if the stock goes up, those $3.30 can go into $5. And you are making money, and they are losing a lot because they shorted something at $3.30, and if this goes to $5.30, they need to pay an extra $2,000, so they lose $2,000, okay? But you win $2,000. So that's those two kind of forces that you have on the market, those that buy to open and those that sell to open. But on both cases, okay, and that's something that I would like to explain you, we have this kind of two traders that are playing the calls for 130. One is long, the other is short. One is waiting for the stock to go up, other is waiting the stock to go down. And you don't know, okay, you don't know, because the open interest, it will increase at the same. So you know that the open interest, if you buy 10 contracts and you leave those contracts open overnight, and if the other trader in the other part of the world sell 10 contracts, okay, the open interest, it will stay flat, okay? Because when the open interest, it will increase by 20 contracts, okay? Because they are open interests, okay? Open interest. And the open interest, it will rise for 20 contracts, okay? 20 contracts that are still open, but they are opposite, okay? When it's looking for upside, other is looking for downside. That's the kind of things. That's why options are so much difficult and hard to for some traders to understand, because everyone can do lots of things and strategy here, okay? And no one has a clue how the hell they are moving and what is behind each contract and each trade, okay? What I want you to understand, at least for now, is something very clear. We will have, once again, this is trying to keep the basics and the concepts, okay? This video is only for the key concepts on options. We will see, and I will try to provide you as many examples as possible, okay, that I can, to provide you to see real time when options volume and there are changes on the market, and that can help you to define when to get in, when to get out, and the direction on the move, okay? I will try to provide that for you. In this case, I just want you to understand that there are two forces on the market. They can be playing exactly the same contract as you. And one is long, buying to open and getting long those calls, and the other one is shorting those calls, okay? And the open interest on the next day, it will increase because we have 20 contracts open, 10 for long, 10 for short, and they are open, and the next day the open interest, it will increase by that value, okay? So for now, just to be clear on the possibilities on the open interest change, okay? When the open interest will reduce, as we saw some minutes ago, we saw that the calls for 130 reduced on 5,000 contracts, okay? What can this mean? It means that someone or some traders closed 5,000 contracts that were open. They could have been shorts that cover the position, and that could have been longs that lock profits, okay? On the move up, longs bought here and closed on the next day until the market closed, okay? And we could have shorts that shorted here looking for downside, and the market continues to rally, and they cover the shorts and close the position. No one knows. Does not matter, okay? And you will see it does not matter right now. You only see that 5,000 contracts were reduced, okay? So that's what I want you to have for now as idea. So let's try to recap a little bit. Once again, try keep things simple. If the stock goes up, you can buy calls, okay? If the stock goes down, you can buy puts. I believe that is pretty much as simple. It was how I started. We have calls on the left side, we have puts on the right side, we have volume, and we have the open interest. We see how the volume increase, we see when the open interest change and how it changed. We have two forces on the options. We have those traders that buy to open, we have traders that sell to open. Both two traders, one is long the calls, the other is short the calls. Both two traders will increase the open interest. So you don't know, and don't try to figure out what the hell they are doing, because we can have edges on the way. This trader can be short the SPY and bought the calls just to edge the short on the SPY. Okay, that's why I don't try to complicate things too much. I try to first look into the charts. That's the most important thing. Okay, here on the options you have lots of edges. You have big money here. You don't have any clue. If you're trying to see every single contract, what the hell they are doing, they can be closing here and rolling here. They can close here and flip for the other side on the put and play for the downside. They can put money from here and make move money for other expiration date. They can move money, closed 5,000 contracts here. They short it out of the money because they think the move is done. But on the other side, you have other traders that are still believing that even if the 1,000 contracts were shorted here, we still have more upside and the stock can continue to rise. So don't try. There are plenty and plenty of traders around the world playing with options. Okay, so don't try to figure out everything. One of the things, okay, options will move. Okay, that's for sure. Options will move based on the price action on the stock. Okay, so first, the most important thing is look, what are your expectations on the stock? Look for the stock, look for the daily chart, look for the intraday chart and build your trading plan. I look for the stock above all the key moving average, stock has been trending up, has pulled back, I believe it can bounce back up, so I will play calls. Market opens, I will look, stock goes up, I look for the options activity, we see volume on the call side, the pricing on the calls is going up, stock is going up, I buy calls. Stock topped here, makes a kind of a double bottom, I prefer to close my calls, I close my calls. Simple, okay? So, and same thing on the put side. I believe that the stock is way too far and gone down. I believe it's going to make a reversal sell, and go check the video on the reversal sell, please. And I believe it will make a reversal sell, so I don't care with the calls. I go with the puts and I buy some puts. Simple, okay? Or you can be this trader. That is also possible. Okay, basically you believe that the move is done, you made your analysis, your trading plan, stock opens, goes from green to red, a reversal sell, and you short, instead of buying puts, you short the calls. And you are making money, because if the expiration days, the calls are below 430, you basically win $3,300. Okay, simple as that. Okay, because you don't even need to cover the position, but even you can cover the position by pennies. So you basically can cover the position at 1 cent. Okay, and you still earn more than $3,300. There are different ways and strategies. Okay, I'm usually a trader that buys to open, but you can be a trader that also sell to open. One of the things, okay, if you are a trader that likes to short, okay, and short only options, and that's okay, that's a very profitable trade, but you need to manage your risk, okay? And we are going to have a video on the risk management. You may need to manage your risk. So one of the things I always suggest traders that like to short options, it's never, but never get naked on short naked calls or puts or whatever, okay? Naked options, never. If you want, you can short spreads, okay? So you can Google it, you can search, and I'm not going to enter into, because this is the options basics, okay? I'm not going to enter into much details, but by shorting a vertical spread, for example, or if you believe that the stock will get stuck here, you can get an iron condor, or you can short the wings and for example, instead of buying a strangle, you can sell a strangler too far out of the money. On the puts and on the calls, you short both because you believe that the price will keep here flat. Okay, yes, that's possible. But for example, if you think that the stock will pull back and you want to short calls, don't get one call short. Okay, you short a spread. Okay, short one contract and the other strike. You buy to cover and to manage your risk, because there you will lock your maximum loss. Okay, one of the things on shorting options, okay, and that's very very important. I can give you here an example. Let's for example see that calls for 433. Okay, let's pick here just to give you an example the risk that you are holding. Okay, the calls 433. Calls 433. Right now at $1.50. Sorry, $1.50. Okay, that's the price. Let's suppose that you believe, okay, stock at 431, stock will not go at 433. I believe it will go down from here. Okay, simple. So I'm going to short. I'm going to sell to open 10 contracts. So basically 10 contracts, 10. So basically I have a credit of $1,500. So I credit that. And if the stock goes and stays below here, below 433 at the expiration days, 2 days from here, and if it goes, those contracts that I shorted to $1.50 go to zero. So $0. I'm okay, no problem. But okay, the problem is, let's suppose that some news come, and that the stock goes to 438, for example. Does not matter. Forget that SPY, does not matter. Any stock goes to 438. What will happen? 438, 2 days from here. What will happen? Those contracts on the expiration date, the call 433 at the expiration date is at $5. Why? That's the difference. Okay, at the expiration date, the price on the option is the difference between the stock price and the strike price. When we are talking on calls in the money, out of the money calls at the expiration date, as I've told you, will go to zero. Okay, every single contract out of the money at the expiration date, at the end of the day, when market close, expiration date, the out of the money contracts are at zero. Okay, the in the money, the fair value, and they will close at the fair value. That's the difference between the stock price and the strike price. So 438 minus 433, $5. So what will happen if you hold the position, okay, something that you short at 1.5, you need to rebuy it because they are in the money, and you are obliged, okay, it's your obligation to close all in the money contracts at or exercise those contracts at expiration date. You will be forced to cover something that you short at 1.5. You need to cover at $5. So if it was 10 contracts, $5, you need to pay to rebuy once again those contracts $1,500. So basically, if you short and you credit your account in 1,500, you need to pay 1,500. You basically lost here $3,500. But the limit, sky is the limit, because this can go to 440, for example. If it goes to 440, okay, 440, or even, let's suppose, more $10. Let's go crazy. Okay, more $10. These are $10. These go to 10. These go to 10,000. Okay, and what will happen? Let's try to increase here. What will happen? You basically lost 8,500. So that's why shorting naked options, it's very, very risky. So that's why if you want to short options, you Google it and short spreads. Look for short spreads, short vertical spreads, or looking for covered calls or whatever. Okay, something that limits your losses. Because here, if the stock and why we can have news. Okay, the stock can go to 453. Okay, 453, and you have 20, 20, 20, and you lost a big amount of money. No, that's your loss. Okay, something that you risked 1,500, you lost a big amount of money. So if you want to short options, go into Google, short spreads. Okay, short vertical spreads, look for covered call, whatever. Okay, but something that limits your losses. That's very, very important, and that's why I usually don't short options. I don't like unless it's intraday. Intraday, yes, we can have it. Okay, for example. Let's go here for a quick example, and I'm going to show you two charts. Okay, so this video is for any kind of trader. Okay, we have traders that buy contracts, and you could have got with, for example, here, okay, calls for 130. They gone all the way from $1.25 all the way into $3. So you could have bought the calls for 130, but okay, but we can also I can also you if you like to short, and if the stock is going up, you can short the puts. Okay, and for example, the puts, when stock goes up, puts go down. And what happened to the puts? Puts at $5 gone all the way into $1.73. So basically here you made more than $3, okay, per contract on the profits. So it's nice. Okay, it's very nice. You can short. Okay, so if you like to short, and if you like to short options, you look, but you don't hold overnight. Okay, you don't hold overnight because the risk is insane. Okay, if you want to short options or naked options, you can try to short, but in my opinion, risk management is very important. You short intraday, and look always on the opposite side of the trade. Okay, the stock goes up, you look, the stock goes up, you short puts. If the stock goes down and you like to short, if the stock goes down, you short calls. Out of the money. The far out of the money, the better. Why? Because the time decay will kick in, and they will lose value very, very fast. Okay, so far out of the money, sell it. Okay, stock plummets, you covered for pennies, and you are done. Okay, always look for the opposite. If you are looking to sell to open, to short options, if you are always looking to buy options, and that's fine also, and as you saw, also very profitable here. Okay, 200%. Okay, and you buy the calls, and you take profits on the way up, but that's a different way, and risk management. Okay, so with this said, I believe I show you the basics on options. Okay, at least the concepts, the main concepts. As I've told you, I don't like to go into too much information, because that starts confusing people. Okay, but I needed to understand the basics for the future videos that I'm going to make. I needed to understand the basics on the options chain, what you see on the options chain, calls, puts, volume, what happens on the volume, what happens on the open interest updates on the next day. One thing that I forgot to mention, something that you can Google also, okay, search for open interest change, okay, and it's very important also, so you can have a bias on what is the market expectation, okay. You want to look on the changes on the open interest from one day to the other. That will give you the bias. If open interest change and increase one day from the other on the call side, it means that probably there are some traders that are expecting an upside move, okay. But they as I've told you, they can also short, okay, sell to open, and the open interest will also increase. So, but that's important. One thing, okay, and I believe that's very important to remind you once again. Trading is not the perfect, there are no magic formulas, okay, and it's very complex when you deal with options. That's why I try to keep it very simple, because I could start talking here about gamma, and now we can squeeze gamma here, and what are the indicators, and start talking about theta, and that you look to be careful on theta, and what is the best delta to get into a trade, whatever, okay. For me, what is important is use have very well consolidated the information on the basics: volume, open interest, calls, puts. A stock goes up, you like to buy instead of short contracts. You like to buy contracts. Stock goes up, you buy calls and ride the position. If you like to short, stock goes up, you short puts, okay? If you want more complex strategies, go with the spreads. You can buy spreads to reduce your risk. Search, in my opinion, some of the best spreads, vertical spreads, very nice. If you know how to measure the move on a stock, calendar spread is even better, okay? But you need to calculate very well the way on the move that is expectable on the stock, to pinpoint exactly the calendar spread perfectly, okay. You also have butterfly spreads that also it's to pinpoint with the estimated move. If you want, look for that, calendar spreads, butterfly spreads. If you want to play the ranges on the stock, if you believe, but everything starts with the charts, okay. If you believe the stock will get stuck here, you can have iron condor, for example, and you can profit from there. Or you can short out of the money calls or out of the money put spreads, for example, and you are okay. So look for that. Once again, the goal of these videos and this course is to keep things very, very simple for you. So I will not go into details on that. I will keep things on the next couple of videos as simple as possible, knowing that options are very complex, and I cannot do miracles, okay, but I will try to keep things very simple. But I give you the tools and I give you the tips. If you want to research for the names that I told you, and you will find plenty of information over the internet, okay. With this said, I believe that I passed you the basics, the main concepts on options, just to give you an overview, and stay tuned for the videos where we are going to live examples on the real trading options, and how can you put your trades based on the sentiment on the options flow. Okay, thank you for watching.